You are listening to Investing Matters, brought to you in association with London South East. This is the show that provides informative, educational and entertaining content from the world of investing. We do not give advice, so please do your own research.
Hello and welcome to the Investing Matters podcast. We are live at the QE2, Westminster, London, for this live panel session. We've got a five-star panel for you of Stephen Yu, Gervais Williams, Gabriel Boyle, George Barrow and Algie Hall. We'll look forward to hearing from them, talking about difficulties of the markets, giving some stock selections and much, much more. Hello there, Algie Hall of CityWire, Elite Companies Editor. Thank you ever so much for joining me on this Investing Matters panel, talking about how to find quality stocks in difficult markets. Can you give me a little synopsis of what your talk is going to be about today, please?
Yeah, Pete, I'm really excited, Peter, because I'm going to be talking about CityWire Elite Companies and the unique rating system that we've developed, which basically tells you how much smart money from the best fund managers in the world, are being put behind different stocks. You know, it's very simple to interpret. And the reason why I think it's so relevant to what we're talking about today, about uncertainty, is because it's pure signal. It's not noise. It's all about following the money. And the money really tells us a very pure indicator of the judgments being made by some of the world's very best investors.
That sounds like an elite panel you're going to be giving there, Algie. So thank you ever so much. Look forward to hearing from you, mate. Thank you. God bless you. Hello and welcome to the UK Investor Show, George. What are you going to be talking about today regarding investing in difficult markets? What's your synopsis of your conversation going to be?
Hi Peter, thank you for having us. So we thought it would be helpful today to talk about some of the lessons that we've learned of investing in challenging markets. There's certainly been one or two of those in the financial sector over the last 10 years. So we thought we'd share that with investors and try to work out how to drive good long-term performance in that kind of volatility.
Brilliant. So that's going to be George Barrow, Apollo Capital. Look forward to hearing your chat later on. Thank you ever so much for joining us today.
Thank you.
Very good morning to you, Gabriel Boyle of Troy Asset Management. So Gabriel, could you just give us a synopsis of your conversation this morning regarding finding quality stocks in difficult markets, please?
Yes. So we've been talking about how challenging the current macroeconomic backdrop is and navigating through that as a stock picker. And our contention is very much that markets persistently underestimate the compounding power of very rare and special businesses that can grow at high rates of return over time. Our view is that in order to navigate difficult markets, you need to be invested in companies that are resilient, that are adaptable, so in practice that means businesses that have high returns, are well managed, are reinvesting in themselves. But very importantly, you have to be very sensitive to valuation. And that's particularly true in periods where you have big movements in interest rates and rise of inflation, etc. So being able to do that in a small boutique asset management firm like Troy, where we have strong alignment of interest, is a big advantage. And so that's what we spoke about today. And the Treasury Global Equity Fund, which is a concentrated strategy with a very long-term perspective, low turnover, and seeks to deliver consistent capital growth to our investors.
Brilliant. Looking forward to it. Thank you ever so much, Gabriel Boyle, Troy Asset Management. Thank you very much.
Thank you. Thank you.
Hello there, Stephen Yu of Blue Whale Capital. Thank you ever so much for joining me on this Investing Matters panel. What's going to be your talk today you're going to give on how to find quality stocks in difficult markets, please? Could you give us a little synopsis, please, Stephen?
Yeah, so I'm going to talk about the new era. Like, we think that there's going to be a new regime in the next 5 years compared to the last 5 years, and certain opportunities that we were involved with before that we're no longer in. But at the same time, equally within the tech space that we are heavily involved with, that we think there's some new exciting opportunities, especially in the AI space. So that's what I'm going to focus on today.
Really looking forward to it, Stephen. Thank you ever so much for joining us today. Really looking forward to it. Take care. Very good morning to you, Gervais Williams of Premier Miton. We're going to do a talk today about how to find stocks during difficult market conditions, Gervais. Could you give us a little synopsis of what that's going to be?
I mean, in summary, clearly you want companies with good safety margins. These are safe balance sheets, companies generating surplus cash and stuff. That's all the conventional stuff. Really, what I really want to talk about is the unconventional stuff and the opportunities for quoted companies, which have the advantage during the recession, but most particularly quoted companies which are small, which can take advantage of weakness of others to expand, but most particularly through acquisition to generate not just good, but actually enhanced return, more upside, more option upside. That's really what I want to talk about today.
Brilliant. Really looking forward to it, Gervais. Thank you ever so much for joining us today.
Great.
Take care. Welcome to the Investing Matters podcast, live at the UK Investor Show. My name is Peter Higgins, and I'm your host for this panel session. And I'm the host for the series of Investing Matters podcasts, which have been with numerous fund managers, journalists, economists, etc., from the City of London and globally as well. And today I'm really chuffed because we've got a 5-star panel for you guys, ladies and gents, here today. And we've got Algie Hall, CityWire editor of Elite Companies, Gervais Williams, author, fund manager, veteran of the City. At various different points in the year, you can see him talking about stocks and shares at various events. So we're really pleased that Gervais is able to join us today. And he's here, and he's going to be giving you lots of different information about stocks and shares. We've also got Stephen Yu, Polar Capital, Blue Whale, fund manager, going to be speaking with us today. Gabriel Boyle, Troy Asset Management, and we've got George Barrow of Polar Capital. So give you a round of applause for our guests, please. Thank you very much. So I'd like to start with my very first guest, and my very first guest today is the author, journalist, award-winning journalist, Algie Hall. And later on today, before we finish this session, I'll be giving all of you a chance to win one of his books, okay? Author of the new book, which I've got here. So Algie Hall, please take the stand for me, please.
So I'm a believer in being very upfront. And so from the off, I wanted to tell you that my talk is a blatant pitch for CityWire Elite Companies, which is a project that I've been involved in developing for just over a year now. But importantly, this blatant pitch is a pitch with a point. Why? It's because I believe what we've developed is very relevant to today's discussion about uncertainty. And also, it's... sorry, okay. Okay, could everyone hear me before? I haven't been... Brilliant. Well, let me know if I'm too close to the mic and your ears are going. But also, I feel what we're working on, the Elite Companies project, it's very relevant to today's discussion, and also it's free. And I'll explain a bit more about both those things a bit later. But first, what is CityWire Elite Companies? So today we've got 4 excellent fund managers who you're going to hear from in a minute after me. But imagine if you had 400 of them. In fact, imagine if the world's 400 best fund managers were vetting investment ideas for you all day, every day. All their resources, research, wisdom, and brain power. At CityWire, we've created a company rating system that does just that. It's a bold claim, so you want to know, how do we do it? We start by using CityWire's 20+ years of experience assessing fund managers' skill to identify the very best equity managers globally out of the 10,000 that we monitor. We call them elite managers. We then get full details of all their portfolios and assess the conviction with which they're backing each of their holdings. Then for each stock, we aggregate the conviction of all elite managers that hold it. Excuse me. We aggregate the conviction of all elite managers that hold it. And from this, we derive our ratings. The top 10% of companies get a AAA rating. The next 20% get a AA rating. The next 30% get a single A rating, and the remaining 40% get a plus rating. The methodology we've developed draws on a growing body of research that suggests managers' most high conviction positions tend to perform best. And the methodology is also independently approved by a leading actuary called AKG. So anyway, circling back to the program, beyond the attractions of knowing where some of the world's best investors have put their money, why do I think this system of rating shares is so relevant at times of uncertainty? The answer is because, as well as being very powerful, the rating system is objective. It's all about signal, not noise. There are plenty of subjective takes on stocks, like broker recommendations, press tips, tweets, and even TikTok. But by following the money, we've created an objective measure of the investment case for companies based on one of the purest indicators of judgment that there is, share ownership. And it's a judgment of some of the world's smartest and best resourced investors. So let's take a very of-the-moment example of this in action, and it's chip company NVIDIA. And everyone today is talking about NVIDIA in terms of AI and the amazing growth opportunities on offer. But if we rewind back to last August, the company released really quite disappointing quarterly results, and all the commentary, or the majority of the commentary, seemed to be about fears of a cyclical downturn. However, at the time, by focusing on the interest in shares of elite managers, we were able to tell our readers that the long-term growth from data centers was really the signal that was attracting the smart money still, and that all the angst of the time really looked like it represented noise. I think since then, when I last looked at the shares, they were up 135% on the back of that, and that part of that's to do with an incredible upgrade that they received at the time of their last quarterlies. However, more importantly than looking at a single case is the fact that after doing this over the year, a year, so far it feels like there are very good ideas thrown up by the ratings. A case in point is our monitoring of the 10 most popular stocks globally since late June last year, which we've been reassessing on a quarterly basis. So far, these stocks have produced a total return of 39%, which is almost 3 times the 14% from the MSCI World Index. That isn't scientific by any means, but it's fairly encouraging, we think. I also said I'd explain why all this is free. Citywire has always had a model with its ratings where it makes money by licensing them, in this case to companies. This means the more people who use our ratings, the better it is for us. And on that point, if you like the idea, and this is where the pitch turns into a plug, if you like the idea, please do check out our Citywire Elite Companies website, and that's fund managers included. Tell your friends, and also please sign up to our weekly newsletter, which is always chock full of ideas. And they're ideas that where we use our data to sort signal from noise. Anyway, that's from me. Thank you very much.
Stay there for me, Algie. Stay there. Okay. So thank you, Algie. What I'd like to do now is enable you, ladies and gents in the audience, to pose 2 questions to Algie regarding this presentation. Is there anyone in the audience that would like to pose a question to Algie? Silence, Algie. Go, Martin. Go for it.
Martin Ingram here. How much of that is driven by quants rather than qualitative analysis? And you can turn it around the other way if you like that question.
Martin, it's a very intriguing question. And I mean, because also when we started on this project, there was a term real intelligence rather than as opposed to artificial intelligence. Because what we're doing is very quantitative, the way we're approaching these ratings, and we're assessing, we're looking at what people are holding, where they've actually got money, and the conviction with which they're, backing shares. So it's in all these processes, that the individuals are using, a lot of it's qualitative. I mean, they will use quantitative techniques inside what they're doing. So there's that, we're focusing in on judgment, but then we're being very qualitative. I mean, I got that the wrong way around. We're being very quantitative in terms of how we're actually assessing it. So we're giving a very pure indication, we like to think of, where that money is and how meaningful that investment is. So so I guess I'd say, it's blending the two. It's kind of taking real human intelligence and, these really smart decisions that fund managers make, and it's turning them into something which is just very easy to understand for everyone involved. So if you go to the site and you see a company has a AAA rating, then that, there have been a lot of really smart people kicking the tires and buying in. And that, we're talking about the top 5% of fund managers here that we're interested in. And they're buying in with conviction. They're not just making, a small overweight. When we say it shares AAA, we say that tells you there's probably quite a lot of them in there. And some of them are making really meaningful bets in terms of the future performance of their portfolios. So that's, so it's a blend, I suppose. Yes.
Brilliant reply. Thank you ever so much, Algie. Can I have a round of applause for Algie Hall, please?
Thank you.
Thanks, Algie.
Thank you very
Take a
much.
seat. Thank you. Okay, we've got another guest. Take a seat. Another guest up for you. And after this person has spoken, have a think about 2 questions to pose to this next panel guest. And we're going to ask George Barrow of Polar Capital to speak next. Please, George, can you take a stand for us? That's yours. Go for it.
Thanks, Peter. Good morning, everyone. My name is George Barrow. I am a co-fund manager on the Polar Capital Global Financials Trust. So focusing on the financial sector, we are reasonably familiar with investing in challenging times over the last few years or so. And Peter asked me to present on what have we learned from investing during those kind of periods. I just thought I'd share with you some lessons from our time to help drive good long-term performance. And I think, first lesson would be recoveries happen really quickly. So yes, you'll get a sharp sell-off, but you can't wait for macro visibility to come through, for non-performing loans to peak and come down, because you'll have missed a lot of the recovery already. So from our perspective, it's important that we do the balance sheet analysis during that crisis time. We stress balance sheets, we stress capital and funding. We get to a position where when we put the companies through a really adverse scenario and we're comfortable that they can come through that, we can then apply a normalized level of profitability. So investing during those times enables you to capture that upside when it happens, because it's very fast. So thinking about the financial crisis, from the lows, US banks were up 50% in the following 2 months from the low. If we think about the pandemic, a similar US banks, they were up 36% from the lows in November 2020. So again, it happens very quickly, and so you have to be invested for that turn, because you won't time that turn. The second point I'd make is the regulatory response to crises in the sector is not uniform, but you do get a broad-based sell-off, and that really opens up opportunities. So at the moment, post SVB, a lot of concerns in the US about how they're going to increase regulation for US banks. That's certainly going to come. So regional banks in the US are going to face tighter regulation. They're probably going to lower the threshold at which banks are brought into that regime to around 100 billion. But because there's been a broad sell-off, that also opens up opportunities. So for the smaller banks below 100 billion of assets, they've sold off significantly. We think a number of those are really good opportunities. So names like East West Bank on the West Coast, names like Esquire, Webster, these will fall below that threshold. They probably won't see much tightening in regulation, and they're good quality banks. Similarly in Europe, we've seen a big sell-off in the sector because of what's happened in the US. We're not sure that read across is that valid, to be honest, from a regulatory perspective, and we expect yields to be very attractive. So a number of our holdings are yielding sort of high single-digit cash yields. We expect them to be able to return maybe 30% of their market cap over the next 3 years. So there's some mispricing going on at the moment. I think a story from a conversation with BNP CFO recently is quite revealing, in that he was in the US when SVB crisis happened. He was trying to get a buyback approved with the ECB, and that day he spoke to the head of the supervisory board of the ECB, and he said, I have some concerns, you're now going to delay or cancel the buyback. And he said, actually, on the contrary, I'm going to accelerate our approval, because we want to demonstrate to the market that we're confident in the levels of capital that you have. So again, that derating, I'm not sure it's that justified in terms of the regulatory response. I think the third lesson would be important to look at the relative winners during a crisis. And as often, you'll make long-term performance from owning those compounders that gradually look to take market share and grow over time. And that's definitely the focus of the trust. So we have a quality bias to what we look at. We're looking for those that can reinforce their competitive position, particularly during times of market stress. And we're seeing that at the moment. So names like JP Morgan, they've definitely been a beneficiary of what's happened in the US. They took in 50 billion worth of deposits inflows during March, during the crisis. They acquired First Republic at what we think are very attractive terms, and they'll certainly generate good long-term value from that acquisition. We saw HSBC acquire SVB UK. Again, we think that's an attractive acquisition. So there will be relative winners from this, and it's trying to find those companies with strong balance sheets that can capitalize on that market dislocation. And that's very much the focus of the trust. And lastly, I'd say there's no substitute for good on-the-ground research, particularly during times of market crisis. So, I'll be traveling to the US next week to visit those banks on the West Coast that are in the eye of the storm, to see the commercial real estate companies that there's a lot of pressure about. But I also remember during 2016, the demonetization that happened in India. So they cancelled all the 500 and 1,000 rupee notes, caused a lot of market disruption, big sell-off, and we were there the week after. It was really helpful to visit Mumbai, visit Chennai, really understand on the ground what is happening. And you could see, yes, there are queues around the block for ATMs, people trying to get cash out, but you could already see businesses finding a workaround. They were using Visa debit cards, checks were still being accepted, people were using prepaid instruments. So we could see that businesses and consumers were adapting already, and it was pushing the economy towards digitization, so a long-term positive. So that gave us the confidence to actually use that sell-off to invest. So I'd leave it there for the lessons that we've learned.
Thank you, George. Barrow, Polar Capital. Do we have any questions for George, please? Anyone in the audience got a question for George? Just bear with me. There you go.
Thank you. Just to understand, the companies you invest in, how is AI impacting those companies? And how do you take in those AI development considerations in your own investments relating to those companies? Thank you.
Thank you very much. Did you hear that question, George?
I got a question about AI impacting the industry. Yeah, I mean, it is impacting, but it's not to the extent that it's really driving the investment case at the moment. So at the margin, you're hearing some companies talking about using it within aspects of their customer service for the big banks. We're hearing fintech using it a bit in terms of their underwriting abilities to score customer credit. So we're hearing about it, but not to the extent that I would place the full investment case on it. But it's certainly coming.
Thank you very much, George. Anyone else with a question for George Barrow? Thank you.
A quick question. What changes have you made since the SVB bankruptcy?
Yeah, it's a good question. So we have gone more defensive initially. So as it happened, we concentrated our exposure more within the large cap companies, particularly within the US. We raised our exposure to more defensive sectors. So we raised non-life insurance, some of the data providers, some of the exchanges. But we also use the sell-off to add to some of the names we've got conviction in within Europe, for instance. So we're adding to some of the banks that we hold there. We think the sell-off is overdone. So some of the names like AIB or HSBC, we think there's real value opportunities there. So becoming more defensive in the US, but then actually using the sell-off to add to the names we've got conviction in. We didn't really change our emerging market or our Asian exposure too much. They didn't see the same sort of sell-off as we saw in developed markets, but we became more defensive initially. But actually now we're actually seeing some opportunities to go back into some of the regional banks' names in the US. So we think the sell-off has become a bit overdone.
Okay, thank you very much, George. That was George Barrow, Polar Capital. Can you give George a round of applause, please? Thank you very much. Our next guest is Gabriel Boyle of Troy Asset Management. Round of applause for Gabriel, please.
Good morning, everyone. Can you hear me okay? It's slightly weird, kind of, yeah. I manage the Trojan Global Equity Fund at Troy Asset Management. I also am head of research. I've been at Troy for 12 years. Prior to that, I worked at Lazard for many years, managing global and prior to that European portfolios. So I've been in this business for quite a long time. And on the subject of how to find quality stocks during difficult market conditions, I mean, to be honest, I can't really remember a time when there weren't difficult market conditions in one form or another. The market is always challenging, whether it's going up or whether it's going down. There's always something to worry about. And our very strong conviction is, as equity investors, that we believe that markets persistently underestimate the compounding power of really rare and special businesses that can grow with sustainably high returns over time. So, that's our sort of conviction, and our whole investment process, our research process, is about exploiting that inefficiency and trying to find those really special companies, trying to avoid the less special companies. And so we avoid fragility, and we seek to own businesses that are very resilient and adaptable, but most importantly, to own them at what we consider to be a fair valuation. So it's that combination of looking for really special businesses, owning resilient ones, businesses that are adapting and reinvesting in themselves, but not paying too much for them. And the thing about times of volatility and challenge is that you're presented with opportunities. And one of the biggest challenges that we face in our industry is it's very noisy, it's very emotional, it can be very difficult at times. So actually, the environment at which you work in is really important. So in our business at Troy, we've tried to create a business which, first of all, is thinks very long term. It's very aligned with our investors. We take our sort of responsibilities as stewards of capital very seriously. We are invested in our funds. We are investors in our business. And we know what we're looking for. So if you've got a clear idea of what you're looking for, it allows you to sort of not have the FOMO all the time and not get too engaged in the sort of frenetic noise that happens. So we manage concentrated portfolios. We have very low turnover, so we typically will have our long-term turnover is 8%, which means we're holding stocks for longer than 10 years in many instances. But it's not no turnover, so we are active. We do take advantage of changes. So, I mean, just sort of taking those points: resilience, adaptability, valuation, and then the kind of softer issues of the way in which we kind of manage the psychology. So in terms of resilience, we're looking to own businesses that are very profitable, are growing, and often sell stuff which is fundamental to our lives. We look to often what we don't do is as important as what we do. So we don't like companies that are very cyclical, very capital intensive. We avoid companies with lots of debt. Management is really important. We try to avoid issues of corporate governance. We actually do not invest in banks because of some of the issues that George was just talking about. That it's a challenging space, a very specialist space, and we avoid that financial leverage. We don't like businesses that are built on leverage. We like companies that have got a clear competitive advantage and where that's very predictable and sustainable. And so that's a sort of key part of the resilience. Oftentimes our companies have got intangible assets. They have pricing power. None of this will sound like rocket science. But the challenge comes in the sort of execution of it and the practice of it on a consistent basis, because it's so easy to get sucked into the noise. I think the other big challenge of this style of investing is that you can become very set. You can become very caught in certain types of businesses. And of course, the reality is that the world is very dynamic. And therefore, to us, adaptability of these businesses is really important. And we're so reminded of that, given what's happened this year. We're operating in a world where the macroeconomic backdrop is really tough, but yet out of nowhere comes ChatGPT and OpenAI, and we're reminded how important that ability to technology and change is to our lives. And for us, we'll invest in a number of companies that are direct beneficiaries of that. So Microsoft, for example, Alphabet. But also when we look at our companies, we're looking to see that they're reinvesting in themselves and that they're able to reinvest and grow at high rates of return. So we'll look at the average company in our portfolio has very high rates of R&D as a percentage of sales, much higher than the average in the market. They're investing in CapEx. They tend to have strong balance sheets and are very cash generative, so they can do that. And so that element of adaptability is absolutely critical. The third piece in all of this, and one which is sort of impossible to overestimate, is that of valuation. So a great business doesn't necessarily make a great investment, and so you've got to think about the valuation side. And we always look at companies in terms of what are we paying and what are we getting on the other side. So what are we getting is all the sort of financial productivity, the growth rates, the return on capital, the margin structure, but then what are we being asked to pay for that? And managing that valuation component is very important to us. And we try to sort of be on the front foot in taking advantage when share prices move very fast, and also being objective in looking to take advantage of volatility. And so, for example, addressing the specific question of how to find quality companies in a difficult market environment, actually we've been presented with lots of opportunities over the past 18 months or so. In our fund, for example, we started a position in LVMH, which is a company we've loved for years, but it always felt a bit expensive. They sold off a lot at the beginning of last year. That gave us an opportunity. We started a position in London Stock Exchange, which has also been a company that's had challenges, but one we thought was very interesting. We've been taking money out of the tech businesses this year as they've been doing very well, for example. And so just being on the front foot. And again, that comes back to this point about working in a firm where we have a clear investment philosophy. We know where we're going. We're thinking long term. We can be patient and be objective, and so that for us is absolutely critical. So I mean, in summary, managing money through challenging markets. Markets are always challenging. Keeping your objectivity, looking to invest very clearly and consistently in resilient.
Level, if you are consumer-facing businesses, whether it's technology company or not technology, you are going to face bigger headwinds going forward to get money from our pockets, because a lot of our money now are being sucked into paying higher energy bills, paying for more expensive goods if you go to supermarkets, and at the same time, if you need to remortgage, we will be paying a much higher rate servicing our mortgage compared to the last few years. But then if you think about some of the names I talked about earlier, like Google, Facebook, or PayPal, or Amazon, they are all consumer facing in a way that is very discretionary based on a very discretionary spending basis. At the same time that if, for example, like during the pandemic, people were sitting at home getting paycheck from the government, it's quite easy that you just go onto Amazon or go to Google to search for certain things and complete a transaction. I'm sure people still do that, but then I think the conversion rate would be much lower now because we need to be more selective in terms of what we can afford and what we cannot afford in the near future. So over the last 18 months, we have exited a lot of these names that we no longer owned, and then we have made the transition going into some of the sectors that we didn't have before, the likes of the US railroads, which we recognize that will be reshoring opportunities in the US, in North America. We gone into Charles Schwab, which we think interest rate is going to stay higher for longer for the next couple of years. And then And then we also have gone into some of the names like semiconductors, equipment, etc. So we think certain things have changed, but then the thing that people would be excited about, which we are still very excited about, is AI. And we were quite a big backer of NVIDIA shares back in 2021 now. And of course, if you follow the shares last year, the market cap fell from $800 billion in 2021 back to 12 at about $300 billion in October last year. And now it just was touching about $1 trillion. So it's gone up a lot, as some other speakers talked about earlier. But what we think is quite real is going to give a second leg to some of the digital transformation opportunities that we talk about, but it's going to be a lot more specific. So within the technology space that we think there's certain things that used to work during the pandemic that you want to get exposure to, which in a new regime, you probably don't want to have as much exposure. But within a subset of that technology bucket, such as semiconductors, likes of NVIDIA, such as Adobe, these names are going to capture the dynamics to the next level. And we think that is going to be very exciting. So that have not changed. But then equally, I think it's important to recognize certain things have changed within the tech space. So I think the last point I want to probably leave today is, I think historically it's quite easy just to think about, whether it's tech or not tech, because during the pandemic, any company that are technology would have done quite well because they would be deemed as pandemic winners. But then going forward, we think within the tech bucket that you need to be highly selective what technology company you are referring to, and names that we have in the fund, we would think that they are the clear winners. Things that we are not in the fund, that either we deem that maybe that going to face some challenges, or maybe they will be losing out to certain competitors. So I would stop here. Happy to take questions.
Thank you very much, Stephen Yu, Blue Whale Growth Fund. Do you have any questions for Stephen? Anyone in the audience got a question? Thank you very much, sir.
What is your view on Palantir?
Peloton.
Palantir.
Oh, Palantir. We have actually done quite a bit of work on the stock. We have not owned it. We are not planning to own it for the time being. It's a company that's very difficult to work out exactly what they do, because obviously, you go through the presentation, you listen to the management team, we've done all this stuff, but it's very unclear exactly what they are producing as a service, because you will hear them talking about contract with all these different governments in the world. They try to piece all this data together to give you a bit of intelligence on the back of the data, but then at the end of the day, it's not entirely clear what they're doing. So for us, is going back to the investment philosophies, we want to invest into high quality businesses, which we understand that we can analyze, that we can make projection, that we can build financial model. And as far as Palantir is concerned, in today's context, it's very difficult for us to do. So we are passing on Palantir. But yeah, you could argue that there's a bit of AI going on, that maybe they would come up with a very innovative product that would be game changing.
Thank you very much for that reply, Stephen. Anyone other questions for Stephen? Thank you.
What do you think gives you the edge, spotting the winners earlier than others?
So I said earlier that we run a highly concentrated portfolio of about 25 to 35 stocks globally. There are 5 of us on the investment team. All we do on a day-to-day basis is to try to find the best opportunities. So obviously, some people would have asked it the other way around, like, there's only 5 of you, how can you cover the world? We couldn't. So what we think we're adding value is the stocks that ended up into the fund that we would deem that we have an edge over others as far as that's concerned. But of course, there are many other stocks that we probably haven't spent as much time and we wouldn't have an edge. But as far as the stocks that we have in the fund, then we think that we have done a lot more work on the back of those companies compared to others when you have quite a few people just focusing on less opportunities.
Right, Stephen Yu of Blue Whale Capital. Thank you very much. Thank you, Stephen. Okay, we have our final guest, Gervase Williams, Head of Equities at Premier Miton. A round of applause for Gervase, please. Thank you, Gervase.
Thanks very much for the opportunity to speak today. Difficult market conditions, yep. I think they can get more difficult, unfortunately. We don't know how difficult they're going to be or how long they're going to last. Quality stocks. I'm going to talk a little bit, I'll probably spend about a minute on the conventional stuff, and then I'm going to talk about something which is a bit more controversial. There are advantages to being listed. And during difficult market conditions, the advantages of being unlisted are much less significant. In fact, there are some major disadvantages to being listed. Often you're much more reliant on debt. Banks change their minds. The advantage of being listed, of course, are related in part to your much more substantial kind of investment in terms of risk capital. You've got much more resilience in your balance sheet. Specifically, when you do get margin pressure, when you do find that companies find that banking is more tough, when you do find you start getting bad debts, yes, we're going to get lots of bad debts. I think we're coming into a recession at the moment. Then obviously having a strong balance sheet is a very great advantage. And particularly if you're listed, you have the advantage of a higher profile. And that can help when you're discussing things with suppliers and customers. They can feel more resilient. You can deal with them more often. So I think the first thing to say, if we are in difficult markets, it's an advantage to be listed. The second thing to say is if we are investing, is to pick for companies which already have an established market position. Whilst it's nice to have an immature market position and companies which are coming through, it's not a great time to invest in difficult market conditions, recessions. It's harder to succeed. So coming back to it, I think you look for businesses with established market positions. Clearly, you can try and invest in companies which are immature rather than mature. They're probably investing in operating in an area which is, at this stage, a structural growth story rather than a cyclical growth story. We heard from Gabriella about that before. And most particularly, you want companies with good safety margins. You're going to get some wrong. We're going to get some wrong. Good safety margins really equals highly cash generative. It means you might be less cash generative, but that's a massive difference between less cash generative and negatively affected by cash outflows. And the last point is, clearly you want companies with very strong balance sheets, but net cash is even better. Again, it means you can be agile, you can move with the markets. And most particularly, we look for management teams which are very close to the front door. There's a lot of management teams who sit in slightly isolated sort of C-suites, and they're fed peeled grapes and all a lot of it. And quite honestly, they're really not very close to the front line. You want companies which are really close to the front door of their business. And then we think things like staff surveys are very good on that. And we're very keen, even on very small companies, to do staff surveys to pick up that. So that's all the conventional stuff. Let's talk about a little bit more unconventional stuff in difficult markets. And our view is that small quota companies succeed better than bigger companies. And that's not just related to the fact that actually they are more small and agile. The real reason why they have the upside is when companies go bust, there's great advantages for those who are acquiring them in the middle of recessions. We did see last year a company called Made.com go bust. If you remember, that came to the market probably 5 years ago. It was a market cap of about 500 million. I think it touched 700 million. And our friends at Next, and I think it was a very good deal for them, bought Made.com for 3.4 million. Now, we don't know what the valuation of Made.com is in truth. It probably isn't 500 million or 700 million. And let's be honest, they probably had to put 25 million of working capital in, maybe more. Don't know what the number was. But they probably had to put, say, 30 million in to make that acquisition. But just assume it's worth 330, then it may be worth an extra 300 million in market cap to Next. Now, Next is an £8.5 billion company. Every 300 million is worth having, but it's only 4% or 3 or 4% in additional earnings and profits. The real advantage to buying insolvent companies isn't just for quoted companies, but most particularly for smaller quoted companies. So as you move down the market cap range, if you think perhaps of a company maybe at 850 million market cap, 1/10 the size of Next, if they made the same acquisition, delivering 300 million of uplift to an 850 million pound company, boy, the maths gets much more interesting. You're talking about maybe 30% improvement, maybe 40% improvement in market cap. And as you move down the market cap range into the smaller microcaps, and the UK leads the world in quoted microcaps, if you're an 85 million pound company, a 100th the size of Next, clearly you haven't got 30 or 40 million to put into an acquisition without the support of your institutions. But you can come and see people like me, and you're going to say, we're going to make an acquisition which might yield 300 million of uplift. We'd like to write a check of 30 or 40 million. Would you like to be involved? And the answer is yes, we would very much like to be involved, because there we are, a company, say, of 150 million market cap after they've written the checks or issued the shares. Well, on that basis, you start to get into uplifts of perhaps 200%. Now, these are all notional figures. Let's not get too excited. Lots of small quoted companies are going to have a tough time. There will be quite a few big companies and indeed small companies which go bust. But for the first time for 30 years, I think it's an advantage to be listed, because I think with inflation, I think we are in difficult times, and I think they're going to be persistently difficult. I don't think inflation is going to be here forever. It'll go away quite soon. I think if we do nothing, I think we'll get negative inflation next year, but we'll get a recession in the meantime. But I think as soon as that unemployment picks up and things, governments will throw money at the problem again. We'll be back into inflation sort of 2 years out and all the rest of it. So I think we've got persistent inflation. I think it's very uncomfortable for highly geared companies. I think unquoted companies have a disadvantage, quoted companies have an advantage, and the areas which are going to have the greatest advantage with option-like upsides are the smaller microcap sector. I'm tremendously excited because actually, as you probably know, the share prices have actually been extraordinarily weak for various technical reasons recently. So you haven't just got the upside from being, the advantage of the upside option value, but you're actually getting in at low valuations at the moment. Thank you very much indeed.
Stay there, Gervais. Gervais Williams, Premier Miton. We've got any questions for Gervais, please?
Hello, thanks very much. I've heard you talk several times. I've read your book. I like you. I've noticed you have. Can you hear me?
I put this on. Yeah, I can hear you now.
Thanks for the talk. I like you. I've seen you talk lots of times. I've read your book.
Yeah.
I noticed you've got a rather large number of companies in your fund, maybe over 100.
Sure.
Why don't you have more confidence in your best, say, 25 ideas?
So for those, I think everyone probably did hear that. So coming back to it, why can't we have the confidence that a lot of other fund managers have in terms of a shortlist? And the answer is because we invest in smallness. If we had $1 billion of clients' money, if they kind enough to give us $1 billion, and if we invested in 50 stocks, that would invest 20 million in each holding. Last week, I don't know if you saw, but U Group, which is our largest holding in our small cap fund, announced a 42% upgrade in earnings. So if you bought U Group, you would have 2 years ago. We bought it 2 years ago. It was less than 20 million market cap. We would have excluded that from our portfolio. Market cap's a bit over 100 now, to be fair. They haven't issued any shares. It's gone up 5 times. But most particularly, if you just believe the analyst forecast, I think they'll do better than the analyst forecast, but we'll see in time. Then 2 years out, when January 25, when they announce their figures, they'll have 70 million of cash in their balance sheet. They've got 18 at the moment. And in a way, it doesn't get more complicated than that. So coming back to the portfolios, the reason for over 100 holdings is because we want to invest in these companies when they're disgustingly cheap. And when they're disgustingly cheap, you can't put much in because they're very low market caps. It's not that we lack conviction. No, completely opposite. Nearly all the institutions won't come anywhere near the 20 million pound companies. But you can get risk-reward ratios which are sensational at the bottom end. That's what we're interested in.
Okay. Thank you very much for that question, Michael. Thank you very much, Gervais Williams, of Premier Miton. Thank you. Take a seat. Okay, at the beginning of this panel discussion, I raised the opportunity of one of you lovely fellas and ladies winning this book, 4 Ways to Beat the Market, which I think we need right now, written by our fantastic guest here, Algie Hall. I have one question to pose to you, and it's a very famous investor by the name of Benjamin Grossbaum. Who is that individual? Benjamin Graham, the book is yours, sir. Can you pass that back there? Okay. I have a second question regarding Benjamin Graham. Where was he born? Anybody got a reply to that question? Wins the second book. No, you can't answer that question, Gervais. Not correct. Sorry, sir. Anybody else? Not correct. Sorry. Yes, the UK. You're getting closer. Who and where in the UK? Anybody? Go for it. His mum. Yes, that's the answer, but which location was she when he arrived from his mum? Anybody? Any takers? London. He was 1 year of age before he moved to New York, sir. This book is yours. I'll get that book to you in a minute. Okie dokie, very well done. Can we have our panel guests up here, please, standing up? Thank you. And I'd like you all to just give our panel guests, Algie Hall, Gervase Williams, Stephen Yu, Gabriel Boyle, and George Barrow, a round of applause. Thank you all for listening to this live Investing Matters podcast recorded at the UK Investor Show with our 5-star panel. We've got lots more fantastic fund managers, analysts and journalists and economists for you going forward. And we hope you enjoy this one. Please subscribe to all of our platforms, including YouTube, LinkedIn and Twitter, for all of your educational needs via the Investing Matters podcast. Take care and God bless you all.
Thank you for taking the time to listen to Investing Matters. Be sure to check out the London South East website for free tools and info to research your next investment. You can also join in the conversation on our social media channels. And don't forget to subscribe to our YouTube channel for more content, including our CEO interviews. Catch you next time.